Hey, what's going on, YouTube? Kenny here, and no live today, but we're going to bring you this kind of macro show today. The internet here has been really sketchy as of late. No, I'm not in the hurricane or anything like that. In fact, I'm in the Deutschland, but for whatever reason, my internet has not been great the last couple of weeks. Hopefully it resolves itself, but if not, we'll always kind of put this up every Saturday, just like we have been. A little late today because I don't know, because internet's uploading slow probably, but other than that, yeah, if you're new to this channel, Redcliffe Research, tongue twister, is an independent research firm. We use a lot of proprietary kind of data sources, proprietary analysis, proprietary sentiment engine, things like that, looking at intangible assets for companies, looking at signal, mostly trying to find tradable signal in the noise, if you will. And so, yeah, if you're new here, welcome. Ex-Special Operations, co-founder of data analytics firm. Okay, so the market has been really choppy, but there has been tradable chop, as like I like to call it. We've been on the wrong side of the AMD trade right now, for sure. AMD is breaking down, and I want to take a look at the chart, and I want to look at some other kind of multiple compression scenarios. In terms of multiple compression, even if we are at the tail end of it, and I think we are getting close to where we could, we still have more downside. I'll just say that. And I want to be really clear here. I am very, very bearish right now. In fact, we are getting into not only, well, there's just no good indicators that are telling me that there should be a bounce anymore. And in fact, I think there should be and can be and could be some institutional and systemic risks that are kind of emerging. So, you know, if you look at what's happening with the U.S. and monetary policy here, yes, we're tightening. We might be over-tightening, and we're going to talk about that. Jeremy Siegel, Wharton professor, is pretty mad at Jay Powell. But even with that, you know, even if you say we're tightening too fast or over tightening and kind of taking the U.S. into a recession without any kind of impetus for a soft landing, then that's fine. But then you still have UK and Japan doing some interesting things. And when I mean interesting, I mean things that are not conducive to bringing down inflation in the rest of the world. And obviously, you know, there's systemic risks there because, you know, if I know that, you know, it's one of those things where, like, if you look at, you know, other instances or other snapshots in time where you look at the Thai bot literally takes down markets, you know, and if so, then why can't the UK easing at a time where they can't or shouldn't be easing, you know, turn that into kind of a liquidity trap, if you will. Japan, same thing. Japan is trying to print their way out of this as well. So can they do it? Should they do it? Who knows? Interesting experiment going on. But I will tell you one thing. Anybody who says they know or is using data in a way that is, I don't know, it's weird. I'll say this. Even as a kind of, as a person who looks at, you know, multiple streams of data, none of it's clean right now. A lot of very high probability setups, high probability data sources are coming in broken. And we'll talk about that throughout this kind of stream, but stream video. Oh man, I miss y'all. I missed the live. I wish I would have been able to do the live with y'all. But anyways, let's get to it. Again, if you're new here, welcome. But let's just go ahead and take a look at some things here. So the first chart that we always like to look at here is the AAII Sentiment indicator. This is just showing bears versus bulls. So bullish rating here, if you're new again, 27% or under will suggest that a year from now, the market should be higher than where it is 100% of the time. We did print below 27% bullish a while back, while back, like about 4, 5, 6 months ago. So this is not something new, but it's retained its lows is all I'm suggesting. This 17% bullish print is one of the lowest bullish prints throughout the AAII Sentiment indicator. So if you look at the bears less bulls kind of histogram, it's looking real nasty. It's statistically significant. That said, there are definitely times, for instance, in 2008 where this doesn't this isn't a contrarian indicator, meaning that it's just right. Like, folks were right to be bearish. Folks were right to risk off and kind of elect to not be in equities, and they were completely right for months and months of time. What I'm trying to suggest is, even though this is a contrarian indicator, when everything's working properly and nothing is wrong, then yes, you should look at this as signal to the upside. But right now, I would suggest that it might not be signal to the upside. Here is the National Association of Active Investment Managers. A little bit of a tongue twister, or maybe not. Maybe I'm just kind of scatterbrained today. But NAAIM Exposure Index showing the lowest levels in at least in the last couple of years. So as you can see here, this is 100% exposure, so fully invested. And anything over that, and we've been at 120 before, is just leverage. So this is leverage long, meaning that you think the market's going to go up bigly. That said, nobody's borrowing on margin right now for sure. And in fact, this is trying to suggest that, like, we're at 15%, kind of 15% exposure to the equities market. This is kind of absurd because what it's suggesting is, well, I mean, I don't quite think that we're 85% cash, but I'm sure cash and cash equivalents are probably somewhere in the range of 50% when it comes to some of these funds. I mean, obviously there's other asset classes and the bonds, and some kind of municipal bonds are doing really well, so I'm sure there's funds flocking to that. Some probably grade A corporate bonds are probably being sold off like crazy too. But right now, equity is not the place for most of these big institutional investors, at least based on this survey. Okay, so based on that, just saying that retail ain't buying, funds aren't buying, managers aren't buying. So let's take a look at what else we can think about here. All right, this is S&P 500. Okay, here's a big kind of thing that we've been talking about. So 360 was a big line in the sand. It hadn't really quite failed yet. You kind of, well, I mean, okay, let's put it this way. You get one here, you get two here, you get this bounce, okay? Technically, this hasn't failed yet, but as you can see here, it's falling through. If we don't bounce come Monday, I'm just going to call it fail. The other thing here is why it's big is this is a regression channel in the blue line. So anything in between here is basically 90% distribution, and 90% of the time should be right. So if you're saying, okay, we bounced here, we were far below the regression trend, and we got a bounce, great. That made a lot of sense, right? But right now we still have room to go to the downside. So even if we peel down to this like natural distribution point, it can easily 90% of the time stay in this kind of channel. So nothing unusual here. Nothing unusual still brings us to 340, which is the next kind of volumetric node to hold some kind of support. We might chop there. We might do some things here and try to fight back up, but there's definitely a gap down here. So risk to reward, there's a huge gap playing out here between 360 and 340, meaning there's just no support here. We're hanging loose, and this is the weekly, so I even zoomed out to the weekly. Obviously, the daily chart is where we like to trade, where we like to think about things, but I'm zooming out for the weekly just to show you the volume profile. Volume profile meaning like where's the institutional memory, where's our most shares being traded. There's just a lot of shares being traded here at 340, but not so much here. And even if you squint really hard and you say like macro-wise, where can it go? Natural resting point, even just from a technical perspective, even from a technical perspective, I would suggest that, the next real significant node is right here. And you can see that right here at 300-ish, which is very silly. I mean, not silly, very painful, I would say, for most people who are long. I can tell you that our trading account is doing really well, but our long-term investment account is still getting beat up, outperforming the market, outperforming ARK for sure. So if you're getting beat up on your long-term portfolio, I mean, I wouldn't sweat it as long as you have a long enough time horizon, you're not trying to retire anytime soon. This is Freddie Mac. You're looking at 30-year mortgage. The only reason I'm bringing this up is we're going logarithmic here. If you're trying to get a loan now, which I kind of have to, me personally, like I have to, and I want to buy a house, we're looking at 6.5% right now, almost 6.75% here. That's pretty significant. So that's the kind of rates right now. If you look at unemployment here is still very low. So the Fed can still do a lot of damage to unemployment. This is the lowest we've seen in quite some time. So this is obviously line charts with the stacking over the years. Just trying to show you that, like, distribution-wise, we're at the bottom end. So we have very low unemployment. So unemployment numbers coming still very low, which would suggest, for the bulls that we could still get a soft landing here. But for the bears, you would say, hey, we need to smash this in the face before we take this down any. So in real terms, what does that mean? That means that you can buy a home right now. Well, here it is. How much home can you buy with $2,500 mortgage payment? Oh, my baby woke up and nobody's there. Hold on. Hey, you guys haven't seen Chompers in a while. Anyway, 1 second. You're on the live, buddy. Can you go get Mama? All right. Chomper, say hi. Oh, sister's here. Here you go. Take him.
I look bad.
It's okay. Take him. Okay. Thanks, baby. All right. So in real terms, $2,500 mortgage, basically $758,000 worth of house you could have bought at those interest rates back in the 2020s. But look at it right now, 2025 going into 2023 here. You get about $476,000 worth of house right now, given what the market conditions look like right now. So in real terms, whereas you could have bought this much, now you can buy this much. That's pretty significant. This is with $2,500. And the reason is, obviously, inflation, housing prices, all these other things, all these other factors. But consider the fact that you don't get as much home for your buck right now. And that's just based on interest rates. So if you wonder why markets do what they do and why the Fed pushes rates around, this is why. This is significant. It's not a little bit, and you're saying to yourself, hey, Kenny, yeah, okay, but we've had 20% interest rates in the 70s. Yeah, it's not really good for the market. Anyways, latest 6.7. This is showing freight from Shanghai to Los Angeles. The reason I'm bringing this up is, again, there's some serious disinflation here. So demand when it comes to things slipping because obviously shipping costs are low. So this is one of those leading indicators. So there's a lot of lagging indicators people are looking at when it comes to different things, when it comes to CPIs, when it comes to producer indexes and stuff like that. But one of the things that lead are transport and transportation. That said, this is why we kind of said back in the day that we were definitely long the transport names, but we kind of got out when Zim kind of hit the forefront, took the trade to the upside, but got out, knowing very well that this would be the time for this to peel. Tommy did a lot of good DD last year on the shipping container and kind of really watching that thing like a hawk, and he did call for March peel. And it's been perfectly right. March 2021 into 2022. It's just demand destruction, boys and girls. So this is UK equities, UK stocks, record this year. Record outflows, meaning people are selling the hell out of this stuff, and I don't know that it's going to stop right here. In fact, I was looking at the UK index that you can trade, looking at the options chain for that, and I don't know that it's too late to short that, but I'm looking more at some consumer discretionary names, specifically for the UK. And the actual pound itself. Excuse me. So given that, I just think that I know it sounds obvious and there can be some kind of contrarian bounce or something like that you might be thinking. I just don't think so, right? I think that it might be early. I think the hangover's coming. You might have to take this position. So if you do take a position like this, so if we're shorting the UK here, you're going to want to give it at least a year. For some of the systemic risk to play out and for it to kind of peel. And I wouldn't go crazy on it because, they can definitely stabilize their economy and do some of the right things. But right now, I do think it's one of those things where, you're kind of like coiling the hose and it's like snaking through, when you were a kid and you kind of, you whipped up on the hose and then the hose makes the thing and then it goes down. Downstream effects, second, third order effects are still coming, and I still think that it's one of those obvious ones. It was just like natural gas before the Ukraine war kicked off, and when we started seeing all the signs of that conflict coming to a head, it was really obvious. And I think this is another obvious trade that, if you have the risk set aside and you're not getting destroyed on the market. And you want to take a position here and you're willing to put it aside for about a year, I think you can definitely short consumer discretionary UK right now, especially some of those funny ones. And when I say funny ones, just take a look at the index itself. They have some leather making companies, some things like that I do think will come under pressure. I wouldn't short some of the luxury brands or the high-end consumer. Still even in UK, but looking at some of the low-end stuff, looking at some of the things that you could cut from your balance sheet, put your mind in that framework, you'll find a bunch of companies that I think will not do well coming up here. So yeah, just some more charts. On pace, this is from BOA, on pace for the worst year ever in terms of outflows. And this is a NYSE Composite index. So you're like, well, how is this different from S&P 500? This is literally every stock in the New York Stock Exchange. And we're breaking down. So this is 2018 high. This is pre-COVID high. And we have fallen below that. Meaning, hey, the bottom is not catching right now. Could it catch here? Definitely could, like from a technical level. But it looks like it's hoping right now. You're just hoping for it to catch. I don't see anything that would change my mind right now. Fed pivot is not anywhere in sight. And again, Jerome Powell, is out hawking the hawks, as they say on CNBC. So here's some asset class valuations throughout history, just to kind of take a look at stuff. And you can see here property. Oh, damn, the housing market's probably going to crash. It's got to crash soon. Boys, girls, it needs to do it in the next 3 months because I need to buy a house. But other than that, yeah, look at it. S&P 500 in the black. And just take a look at this chart. Okay, so low confidence in the Fed continues. If you didn't watch this, you need to watch it. In fact, I'm going to play it for you right now. Jeremy Siegel was on CNBC. Never seen this animated, never seen this pissed, but he's pissed. And so I want to show you what pissed looks like from a Wharton professor.
Yeah, certainly. Scott, I find it very amusing. A year ago at that September meeting, when we had booming commodity prices, when housing prices rising at the fastest rate in post-war history, when we had all commodities going up at rapid rates, Fed Chairman Powell and the Fed said, we don't see any inflation. We see no need to raise interest rates in 2022. Now, when all those very same commodities and asset prices are going down, he sees, stubborn inflation that requires the Fed to stay tight all the way through 2023. Makes absolutely no sense to me whatsoever. Way too tight. We do not have to get anywhere near that level to stop inflation because all the inflation is basically stopped. I mean, you had a headline just came across 3 minutes ago, oil back to January levels. That's before Russia invaded Ukraine. You can see what's happening to commodities. We're going to get the Case-Shiller index next week. It's going to show no increase or a decrease for the first time in years. And that's a lagged indicator. On the ground, commodity, all the prices are going down. The only thing that's not going down is wages. And by the way, wages are in catch-up mode. Don't argue they're pushing inflation. They're lagging inflation. I mean, the workers are trying to get what a little bit back of what the inflation happens to be. I think the Fed is just way too tight. They're making exactly the same mistake on the other side that they made a year ago.
There are those who agree with you, who think that the Fed is oversteering.
Yeah.
But saying it doesn't do anything for the scenario that we're currently in. If they continue to do it, whether you think it's right or wrong, if they continue to do it, what does it mean for stocks?
Well, until he sees the light and says, you know what, I don't think we have to be so tight. Until that happens, you can still have pressure on stocks. I mean, and that's gonna, that's probably one of the factors that can see the light. I mean, when he sees how high real rates have gone, the dollar the highest in 20 or 30 years. By the way, next Tuesday we're going to get the monthly stock market money supply data, which is going to show the greatest decline in 5 months that we've had in the post-war period. I mean, if he looks at any of the monetary or financial indicators, he can't say, oh, we have to keep them high. I mean, at his press conference, he said, we have to get real rates in the positive territory. They're in positive territory for every maturity. For the first time in years, we're already there. I thought that was the most uninformative. And no one was asking him a hard question. How do we have 3.2 million new workers and GDP going down? What does that mean? What does the record decline in the money supply mean? I mean, what does the collapse in commodity prices mean? What is the lag construction of these housing indicators that are 40% of the core inflation, which are going to filter through inflation for the next 12 to 15 months? Is that what he's looking at? Why is he looking at that? That's not an accurate view of what housing inflation is. I mean, there were no hard questions. There were 50 reporters there. I don't know. They basically said, repeat the statement you made at the beginning. There's so many things to ask him. What is he actually looking at? I mean, he's looking at 3-month annualized core inflation that is a lag. While we all look at market, look at what does the stock market do? It looks at market-oriented data. And that's what Professor, the Fed should be looking at.
I don't know that I've seen you this animated. You seem downright
I am very
angry
upset. Yes, I am. I'm afraid it's like a pendulum. They were way too easy, as I've told you and many others through 2020, 2021. And now, oh my God, we're going to be real tough guys until we crush the economy. I mean, that is just, to me, absolutely poor monetary policy would be an understatement.
I mean, look, I'm watching Twitter. I know it's only a small sample size. I'm watching Twitter, and they're like, "Go, Professor, you're right."
Well, I mean, I think we're giving Powell. Yeah, honestly, we're giving him too much of a. Oh, good, he's standing against inflation. We're giving him too much praise. I mean, listen, the Fed has just, executed the last 2 years one of the biggest policy mistakes in the 110-year history of the Fed, by staying so easy when everything was booming and pointing to, my God, inflation is going to be a terrible problem. And now, oh yeah, we did goof badly there, which he never really admitted. I mean, he still blames some things on Ukraine and, Putin and the supply side, even though oil is way below that level, way beyond that. And now we're saying, oh my God, he's the God that's going to stop inflation, and he's going to crush the wages, which have fallen behind inflation by 3, 4, 5%. You can't have cost push inflation when you're lagging inflation. You can't blame wages for inflation when they're 2, 3, 4, 5% behind inflation. I mean,
he said the other
why
day
is he putting the burden on these working people, on the employed?
All right, well, that was worth the watch. There's a lot more, but I think you get the gist of it. Honestly, it was a really good kind of watch because Not that he's getting pissed or anything like that and sensationalizing it. He's not. This is one of those gentlemen that is a gentleman. He did come out the other side, but even here, he doesn't think it's right to be this hawkish. That said, again, just another kind of thought here. But this is what I mean. Low confidence in the Fed continues, and that includes my confidence. And so if they continue to do this, and they continue not to lighten up, which it doesn't look like they will be. It looks like there's I don't know who's working there. I have no freaking clue, but I would suggest that there's probably some real young PhDs, early 30s, maybe late 20s, that are doing a lot of great work that doesn't match up with what the ground truth or what the ramifications of what really things feel like to people should mean. So I don't know. This would have been great for the live. I think we would have had a great conversation on live. But even though it's not live, you can still put in the comments. I'm going to read the comments and I'll get back to you. But I just still, man, it's just, the Fed has not done a great job. And I kind of agree here. It's easy to be a backseat quarterback. So I'm not trying to be like, okay, he did everything wrong. We didn't know how bad the pandemic was going to be. And so, there's a lot of things that were probably measured and they were fine. But, sometimes like I really, some people don't. So watch out here. This might be controversial. I do appreciate somebody who can tell me that they were wrong and say that they were sorry. But culturally, that doesn't play out in a lot of different cultures and a lot of different kind of secular nuances. But, whatever, man. For me, I would have liked to see this thing kind of average out and figure out what the good balance is. But it doesn't look like it right now. Still, we're looking at real serious rate hikes and looks like a serious hawk when it comes to the tightening policy. In fact, we know that because we've been following the dollar, and you've seen the dollar goes parabolic vis-a-vis everything else. Okay, this is for the Patreons. I just wanted to go over this. This was a 90% success rate, but for each day, when you take these trades, just really quickly, I'm just going to gloss over this because I know a bunch of you all aren't Patreons, but thank you so much for the 25 supporters that we still have. Thank you so much. But anyways, point is, so you can see here, this was like a 90-95% success rate. It's still relatively high success rate. So you're looking at here almost this is 7 out of 10 that works, and then 1 no trade. So we'll just call it 7 out of 9. Because 1 you don't get a trade. So 7 out of 9, you're still looking at a very, very high success rate here. 1, 2, 3, 4, 5, 6, 7. Point is, a lot of folks when they're day trading, when they're intraday scalping, look for 40%, 50% success rate. And as long as your R1 to R2 risk to reward is solid, you make a ton of money. But essentially here, just looking through this, just remember, you still need to bring your trading hat on here. If you have any questions, just ask me in the chat. We'll go over it. We'll kind of walk through it. If you want, we can actually do some live stuff. I just need to hear from you and somebody say, hey, yeah, I'd like to see it live. But essentially, you get a trade right here, and you get probably a 40 or 50% move on the intraday options if you use the strategy we have, and you would have got one right here too on this bounce right there. And end of the day, that would have been a nice 100% probably. Here you can see it works just fine. I mean, obviously you get blasted on this day and this day, but really you only get blasted 2 days out of all of this. I'm only saying this because, if you're finding it hard to trade chop, this really procedurally looks at how institutions want to throw you off sides intraday in the beginning of the day. So where there is low liquidity, low volume, they tend to try to move these spikes, and then they kind of contrarianly, that's not a word, I know that, but just for funsies, saying that word, but, it tries to goes and peels the other way. The point is, I 10x in a trading account recently using this, a small one, so relax. So I took it from like $3,000 to about $30,000. So I mean, look, you can day trade this. You can. There's ways to do it. I'm not saying this is the only way to do it, but I mean, this was a 90% success rate. It drops down to like 75%, but it's still good. But just remember, don't just abandon it just because it doesn't work one day. So like, say you come in here and you're like, you took that trade and you're like, damn, this doesn't work. Just make sure you just keep doing it day after day after day after day after day. Give it some time to work out and give the law of large averages, large numbers, a chance to work itself out. And if you do, it's convincing. It's convincing. And I want to do an episode or a video after this, kind of showing you the math. Even if you do like 1% a day, it's bonkers, right? But I'll show you what this kind of looks like and why it's relatively, I'm not going to say easy. It's not easy. You do have to execute properly, and you do have to respect stop losses, and you do have to get your position sizing very, very right. But if you do all that and you're an experienced trader, you have some experience, things like this, systematically, go with it. Go use the process, and don't try to kind of overfit or over safe, which is not a word. Don't try to make this thing too safe. You're going to lose trades, right? You're going to lose trades. This is as safe as it gets. Just when you get a bad day, you trade and you don't get it, you don't get it. So you got in this day, just make sure you respect your stop loss and don't get fully blown out. And if you do that, all these days will recover into the green for you. And I'm really sitting here and expressing this and talking about this, not because I'm trying to say anything one way or the other. The reason I'm doing this is because, yes, if you're having a hard time with the markets and you don't want to steer at the markets, that's cool. Just go away. And I know this is happening because we look at other alternative data sources. We know people are not looking at YouTube in terms of stocks, not just our channel, but every other channel as well. In terms of views and stuff, people aren't just there because the easy money isn't here anymore. But if you're still here, if you're still fighting and you're still checking us out and you're still watching videos, then you know that there's alpha to be had out there. So if you think that there is alpha, just find a system. It doesn't have to be this one, but this is one that's working for me. And yeah, I don't have to play around too much. It's relatively easy. Execution is the hardest part, but it generally works. So it's just something to look at. Hey, just going to audit some trades. This is Bull, so Bolero Company. Really, really interesting. Trending up, volume profile wise, you have a good support here at $10. It's working its way back down, but still very, very resilient. So trend still up. Could it come down and kind of revisit 8? Fundamentally, if it does, probably a buy. The books look really clean. They're acquiring, and they're kind of just franchising literally almost every profitable bowling institution in America, and really just kind of revamping it. So there's a ton of total addressable market there, and people are bowling. And if you look at the kind of annual or the quarterly presentation, it's just a numbers game, and it's pretty obvious, and I don't think it's that hard. But anyways. So bowling, if you're interested, take a look at this company. It's probably going to be a buy if it hits $10. But right now, no need to buy anything unless it's really, really zooming to the upside. Like, for instance, if I bought here, like say it reached $11 and I wanted to buy this trend bounce, if it drops to like $11, you want to get out because you would want to see a hard, fast bounce from here. But companies like this, they're outperforming right now in a market that is underperforming. So given that, for whatever reason, this consumer discretionary, you would think bowling would slow down, but it's not. I've checked even here in the local German bowling alleys. It's pretty serious. But even myself, I've tossed a couple balls down the lane recently, more than a couple. So I feel it, and I'm not just bringing it to you because of that, but the numbers still do look good. Okay. This is TK Tankers. We talked about it right here. It made like a 15% move the day after we talked about it. So trading algos took a whack at it, at all-time highs. Never got the trade or anything like that, and it kind of peeled down, and it's making a move back up. So what do I think? I think you can buy here. Anything over 25, you could buy it, but just know that if it breaks this 24 thing, you've lost your trade. Like, this volume profile here is where you should put a line in the sand. So if you're looking for stuff to long and you're just really getting sick of shorting everything because you think there's going to be a serious bounce, then you want to look at companies like this that can survive the peel, and then you can get ready for the bounce. Obviously, you know that based on the last video, a lot of lithium stocks and stuff like that are the ones that we were looking at. So FREY is one that we were looking at. This has EU exposure, unfortunately, but fortunately, it's sitting on some serious support here. There's 1, there's 2, that's 3, that's 4. This is like the 5th bounce here. So 1, 2, 3, 4, 5. It is definitely coiling here. I was taking a look at this TTM, like the squeeze indicators, not actually squeezing here. So meaning trend is still on the upside and it's still working its way and trying to resolve to the upside. Really easy line in the sand. The stop is obviously 1330-ish. So might be another long trade that you want to get on. And we were talking about it last episode. You know, it looks like positioning-wise, electric vehicle market is pretty resilient here. So something you might want to look at. Okay, so AMD, this is big. So when I talked about a lot of signals failing, the reason I mentioned this is because TTM squeeze for AMD 4, 5, 6. I think there was even more than that, but here six times it was completely right, and we try to front load this, and it's completely failing. But if you look at volume profile, as you can see, this is the weekly too, is zoomed out to make sure we understand what the consequences are right now. 75 was the line in the sand, and we broke it, meaning, you know, as bullish as I am on AMD and Lisa Sue, if you are short here, the probability is that we hit 50. And if we don't keep 50 for whatever reason, well, there's just no way we don't keep 50. But as we've broken 75, the move would have been to short here. I did not think 75 would have broken. I just didn't. But we are in a different world right now, and the macro has changed. So I was definitely wrong that 75 was going to hold here. We did have a lot of support. We did have a lot of volume. We did have a lot of kind of conviction when it comes to just the overall, even with multiple compression, even with the softening sales in the PC market, our discounted models, risk to reward, still showing. Even if you say 120 is not it anymore, I got to tell you that, you know, I'm still running a couple different models, but every model that we spit out still looks at $100 AMD, even with very tight multiple compression. And if you're asking where are we at when it comes to multiple compression compared to earnings compression, right now, even if you bake in earnings compression with multiple compression with about 20% more PE to compress, AMD still sits at a good $100, $90 to $100. We'll break it down completely really soon, but there's definitely macro risk here. And there's some risk to foreign currency exposure and stuff like that. But in terms of where we are, this just becomes a longer term play. The thing about AMD and the reason why we like it so much is, like, given NVIDIA and where it sits as king of the hill and where AMD is in terms of like demonstrative growth, AMD is still actually a growth company. I don't want to say NVIDIA is not a growth company. It's definitely a high and leading tech name, but AMD, given what the CAGR or the annual growth rate for this company is, and the market share that it's taking, and the way it's eating Intel's lunch, it's really truly a growth name in an environment that is not giving growth any credit. This is not a zombie company. This is one of the best premier growth companies there is out there. And, you know, we can play out the thesis any which way you want, but the valuation story for us is that indeed But right now, obviously trending down. No reason to get in the way of this. 50 seems like the line in the sand. We're already loading up, and we are down a bunch, even in the kind of public-facing portfolio. But that said, given 50, I'm going to swoop in here. I wouldn't even buy, at 50, I think, you got, even at 75, I think if you have 1 or 2 year leaps, you're fine. Buy very far out if you're doing options. I really recommend that you just stay with equity at this point, because AMD will absolutely 100%. You can't say 100%. I'm not a financial advisor, et cetera, but you're going to double your money on AMD at this point, especially if you have any kind of options trades here. But you're going to really double your money, even equity-wise, as soon as things recover. And I think semis are definitely first to recover when it comes to the bounce. There's going to be high-risk assets that bounce fast. Bitcoin probably will bounce fast, and then names like this definitely have to bounce. They don't have to bounce, but given how much this money, giving the EPS estimates, we'll see though. We got to see what Lisa says on earnings. It's going to be important. This earnings call is going to be very important. We need to see how soft the consumer actually is. If the consumer is still strong and B2B is still good, given the ramp cycle for the data centers, it's going to blow earnings out of the water. It might run really, really fast. But right now, probability is snowball is going down the hill, and so therefore it may go down the hill and hit 50. I don't know. Nobody knows. If somebody's going to sit here and argue with me, go ahead and argue. I'm just giving you the probability of what I'm thinking and how I'm positioning my money. Am I still DCAing? Absolutely. Am I still selling kidneys? Selling all the plasma and kidneys you can. I think you only need 1 kidney, boys and girls. So there you go. But yeah, we'll see what happens, man. Yeah, this is the TTM that we were trying to show you, that it just failed through. It's just not working. This is Booz Allen. We've been talking about this. This is our Palantir. This is our anti-Palantir player, meaning that we think it beats Palantir in nearly everything. It's consulting heavy, but Palantir is also, people don't know that or don't think it is, but it is. But it was at all-time highs over here, pretty close to it, double topped, and it's peeling. The reason I'm showing you this, or the reason I'm suggesting this, is in terms of defense spending and defense companies and defense names that are sitting at the precipice of kind of innovation, given not innovation, but let's backtrack this. Given their institutional tentacles and their reach, and some of the intangible assets that we have in terms of network effects, given the DoD, especially there's like documentation and memorandi that are literally talking about how they will use Booz Allen proprietary systems for data monetization. It's a good play. And if you think, another sector needs to lead us out of here, it's either, to me, it's either healthcare or defense. And this is one of the defense names that I think can lead the market out. Remember, what led the market before never leads the market again. So if you're thinking tech and you're thinking NVIDIA, even AMD, it's not that it can't do well on the way back out, but it doesn't tend to lead. So I'm looking for things that lead. But then again, just remember, given this bear market and given what you're seeing, there is a situation where if it falls back into this channel, we can still plummet and see 76.58, which becomes still valuable as a company. But, if you start to see this happen, I'm not suggesting to short it, but, you can get a better discount here. So I'm not a buyer here, but I'm suggesting that we might be falling back into range. And if you fall back into range, I'm not suggesting to short it either, though, because there's plenty of bad companies to short right now that haven't compressed. But we want to see how resilient this is. And if we get to 75 again, I'm definitely a buyer. 76.58 here on this chart. And quite frankly, I just want to thank the Patreon so much. All 25 of you that are sticking it with us. We do have some cool stuff coming up. I do want to forgive. I do want to ask for your forgiveness, Patreons, for some of the videos that I know were supposed to come up next month previously, the month previously before that. Talking to folks like Alex, who I know wanted options. And so we'll do it. We'll do the Redcliffe research version of options, which is a very nonsensical version of like how I use options. I do try to simplify it. Do we do the wheel? Not really. I don't like it. It adds a lot of complicated elements to it. Do we do strangles? Yes, absolutely. Do we do some of these iron condors or what else? Or do we sell premium? Sometimes, but I don't really do that. A lot of it is just making sure your call options, premiums, and the implied volatility of each contract is right, and it's right size for you, and the risk to reward is good. So it's really how you manage risk to reward. Some people manage it in different ways, and so I think for us here at Redcliffe, it's to simplify that version of it so you can quickly see what risk to reward looks like when it comes to developing your option strategy and your options trading. Things like that. And so, yeah, we will go over those things. I will definitely fill out and flesh out that entire course. I know we're at video 6 or something where we're supposed to be at video 20 right now. We'll get there. I would say be patient, but you have been, and I really, really appreciate that. Obviously, we're working overtime when Ukraine kicked off, so it is what it is. But we appreciate you being here. Macro newsletter is coming this week. Hopefully, we can bring some serious signal to the noise when it comes to really looking at what multiple compression looks like for companies like AMD, and then maybe you can kind of garner or kind of take a gander at what that might mean for some of your beloved stocks that you were looking at. But anyways, it's not quite an hour, 45 or 46 minutes here I'm looking at. But yeah, I didn't have anybody chop it up with to talk to, but hopefully we can do live next week. If not, we'll get another video like this. But either way, thanks so much for watching. If you like this kind of thing, you know what to do. Hit some buttons. And I guess, I don't know, hit the like button or something. Jeez, I never said that before. I'm saying it now because stuff. Machines, computers, algorithms, and either way, might start seeing some shorts soon, and might start seeing really decent daily content. But forgive me for the rust, and we'll see. Hopefully we can start the daily Redcliffe research train again. I've made time for it, but it's pretty rusty. Trying to get the cobwebs off, trying to get this whole editing and everything, and there's no editing obviously, but this whole format back together, and just find the time for it as everybody is. Got that little guy, got Chompers over there. He's chomping it up. But yeah, thanks for watching, and thanks for watching to the end. Let me know what you think is going to happen with the market here. I actually just want to know, do you think from here this is the bottom? Like, that's the question I want you to ask right now. Have we already bottomed? It's hard to say that we have, because we actually fallen down past previous lows. And so if we don't bottom here, if we don't bounce on Monday, geez. Anyways, yeah, again, thanks for watching, and we will see you later. Take care, everybody.